Hi, it's Carl Lishing again, independent insurance agent out of Lakewood, Ohio. Today's topic, we're going to go a little bit deeper on life insurance and the internal mechanics of it, so people kind of get an idea of how it works behind the scenes, other than just your monthly premium. So let's talk a little bit about a human mortality table. Not the funnest thing to think about, but it's reality and why we should. So let's take down here at age 0, newborn. These days, they're stretching these actuarial tables, how they calculate rates, out to age 120. They used to go to about 95 or 100, but more and more people were living past that, and their policies were expiring. So now they're stretching it out to 120 in a lot of cases. Now, in the first year of life, there could be higher mortality rates, complications of childbirth, SIDS deaths, things that are very sad to think about, but it happens. And then if the human survives that first year of life, mortality rates come down and they stay fairly low. We're going to see a little bit of a bump in mortality rates in the adolescent years and young adult years. And we can probably get an idea of what's going on there. Maybe a little bit of reckless behavior, alcohol, drugs, bulletproof and invincible. Who knows? Things happen. Now, if we survive those years, then mortality rates come down. 30s, 40s, 50s, more things start happening, 60s, 70s, and it's going to go like that. None of us get out of this place alive. So the actuaries, the people that figure out the numbers for the insurance company, when a person applies, they're doing a mortality assessment. They're trying to guess how long they think these people are going to live based on risk factors. Everybody starts off with standard rates, and standard rates are based on the average male and female life expectancy based on the year that they were born. Now, some people, if build, height, and weight is in line with the preferred charts, driving record's good, there's no family history of cardiovascular or cancer deaths before the age of 65, everything checks out pretty good, they might be able to go better than standard rates because the underwriters think that they're going to live longer than the average, so they can qualify for what's called a preferred rate or preferred select. Different companies call it different things. So you got standard, you got preferred rates, which are going to be lower, and preferred select, which is like the best rates, the lowest rates that somebody's going to get. You can go the other way too. If there's risk factors there that could have an impact on mortality, they can get what's called a table rating. And table ratings are A, B, C, D. They go up. And the higher the letter or number, the higher the risk class, the higher the premium. So on term life insurance, the way it's going to work is, let's say somebody applies for coverage right here, and they're looking at it buying a 10-year term. They're going to spread the cost of that out over 10 years. 15-year is going to go like this, 20-year like that, 30-year like that. So the longer the term, the higher the price, as mentioned in the previous video, because there's more probability that that person's going to die in that larger window of time compared to a shorter window of time. With whole life, what they're going to do is take a look at the age that that person applies. The costs are going to be higher because what they're doing is they're taking the cost of the insurance and they're spreading it out over their whole life. So it's going to be a little bit higher. There could be some cash accumulation, fixed death benefits, things of that nature. And on the internal mechanics of what's called a universal life, it's the insurance charges within the policy are going to go up a little bit each year. So in year 1, it's here. Now, the person's premium doesn't change. It's just what's going towards the cost of insurance charges inside the policy. I'm going to get a little bit more detail on that here in a second. They're going like this over time. Got the idea? I can keep going, but I'll run out of room. So it goes like that. So with universal life insurance, early in the policy's life, people are putting money into it. There's a small amount going towards cost of insurance, and then the rest of it's going into like a cash accumulation kind of fund. Now that cash accumulation fund, it can be designed to cover insurance charges in the future, or it can be designed for cash accumulation. In a previous video, I talked about how universal life can be built to focus on cash accumulation as kind of like a financial tool with death benefit protection and living benefits, or it can be focused on what's called more of a guaranteed death benefit, where the money's not focusing in on cash accumulation. It's more going towards ensuring that the insurance is going to be there for a longer period of time and paying it for a certain period of time. So down here, when they're buying it early, there's more money going into the cash fund to help offset these higher charges in the future. So if it's set up correctly and funded correctly, the policy can perform well. However, if it's not set up correctly and funded correctly, universal life might not perform well or lapse early, because there needs to be cash accumulation in it. In a lot of cases, not all cases. There's exceptions for the guaranteed products. Now, let's talk a little bit about these cash accumulation funds on universal life insurance and how that works. So let's get a 55-gallon drum out. Picture this thing going in your backyard. You're going to go grab the garden hose and stick the garden hose in there. And then over on the side of the house, there's a spigot. Now, if you go over here and you just open that thing up a little bit and the water's trickling in, this water level is going to represent the cash value. So if you don't put much into it, it's going to take forever for this 55-gallon drum to fill up, or a long time. Now, if you go over to this valve here and you open it up and you start putting more into it, that's your premium contribution, premiums that you pay in, they're going to cause that cash value to go up. It's also going to earn interest. Now, the different kinds of universal life policies, some of them are index universal life, where if the market goes up, you participate in gains. Sometimes there's some high-end limits on that, depends on the plan. If the market goes down, there's like a low-end floor, so you can't lose principal on a negative return in a bad year when the economy goes down. There's variable products where if the market does go down, you participate in downs as well as participating in ups. The more popular universal products these days are index products, because you can't have a negative return. There's still insurance charges. Now let's talk a little bit about that. So over here, there's another valve that's going on. There's money coming out of the bottom of the barrel. And that money that's coming out of the bottom of the barrel is for cost of insurance and administrative fees. Now, term life insurance has administrative fees built into it as well. You just don't see it. It's on that monthly premium. There's insurance charges here that they're collecting money so they can pay out death benefit claims when they come in. Now, with cash accumulation focused universal life, to fund it correctly, what you do is you go over here to this little valve and you tighten it down to minimize the charges that are coming out for insurance. It's called minimum face. So you reduce the face amount, get the minimum face that you can to minimize the insurance charges, and you go over here to this valve and you open it up and you overfund it. That's how this policy is designed to accumulate cash. So you're getting interest credited, principal being paid in, time value of money. They can, depending on how they're set up, they can accumulate decent amounts of money in there. And then when people pull it out, there's different ways to access the money, and some of them can be tax-free. That would involve a little bit deeper of a conversation, more on a one-on-one basis on how different options to access cash. This is just like a high-level overview. It's a little bit more detail. These policies can also be designed for long-term death benefit protection. I mentioned that in another video, where you can guarantee the coverage in place out to age 120, whatever face amount you want, and pay it all the way to keep the price down as much as possible. Or you can pay it to a certain age where you're paying more up front, but then that policy is still in force, and then in the later years you're not paying for it. So that's a little bit about the mechanics on life insurance and how it works behind the scenes. Hopefully you find that interesting. Probably not, who knows, but there's people that like a little bit of details. So that's what this video is for. If you want to have a further conversation about life insurance, the mechanics of it, what kind is the right thing for you, just give us a call or click on the schedule appointment button on the website, and we'll guide you through. Thanks again for your time. Bye for now.